Welcome everyone to our Wednesday night Multifamily Freedom Chasers Zoom call. My name is Shelly Miles. I am an author and a commercial mortgage broker and the co-founder of our brokerage company, Adventure Commercial Capital, together with Mr. Jerry Miles. Wave for those of you who don't know us. What our company does at Adventure Commercial Capital is connect real estate investors like yourself to lenders, investors who want to buy multifamily, fix and flip storage units, hotels, any business that has real estate attached to it, because each investor is unique and each deal is unique, and we have the skills to connect you to the right lender. If this is your first time here, can you put a 1 in the chat so we can say hi? And we want to welcome you and hope we can add value to your real estate journey. Let me see. All right, I think everybody, it's been a while. Okay. Well, glad you're back. Glad everybody's back. All right, so I'm going to go through today's agenda. We're going to introduce the community ecosystem for those who do not know, and plus this is being recorded, so a lot more other people's going to see it too. So that's why we keep repeating ourselves every month. We're going to do introductions. Jerry's going to give you the current debt market update. We're going to get into our main topic, which is all about financing those smaller deals, and then we'll have some Q&A. If you do have a question, put it in the chat and I will read it to him. But we do hold our Q&A section for those Access Pass members, and I will let you know how to get into that at the end. Jerry?
Yep. All right, great. All right. For those of you that are newer, I'll introduce you to the Freedom Chasers community. We do these calls. We was doing last year. We did 2 a week. This year we're doing 1 a week. And this is how it breaks down. The first Monday of every month, we have Trevor Walker, and he does the activation call. Usually a celebrity guest or a big time investor that's on those as a guest. We do asset management the second Monday of the month with Iffy and BB, and they have been scooping up quite a few deals here recently. The third Wednesday is myself and Shelly, and we talk about the financing portion of the deals. The fourth Wednesday of the month, we have deal sourcing and underwriting with Ed and Kevin. Ed and Kevin are both full-time brokers, and now I believe each have a few multifamily deals under their belts as well too. So a lot of value to be gained from being on these calls. So make sure that you're jumping on and getting as much of this information as you can get.
Yeah, and I just dropped the link in the chat to the Facebook page. This way you'll get the updates on the events, on all those events that he just mentioned there. You will be getting updates and invites, and we'll just, let you know when the next call is. So click the link and join the Facebook community page so you can get those updates as well.
Yep. All right. So these are all different ways to plug into the multifamily Freedom Chasers ecosystem. We have our YouTube page with just about all of our calls that we've done over the last 2 years, I guess, are on record there. Spotify, Facebook, Instagram, WhatsApp. So get on those and be as active as you can be on these calls. This is the link for the WhatsApp group. You can take a picture of that link and join. There are some, if you have deals that you're wanting to get done, you need sponsors, things like that. There are people in this WhatsApp chat that can help you out with those things. So put your deals out there, let people know who you are, and those types of things. Who are the Miles? We are commercial mortgage brokers and the co-founders of Adventure Commercial Capital. That pictures me and my wife there and our two boys. Um, I guess that was at JJ's graduation that was taken at. That was just last June. He graduated high school. Um, we lend on commercial real estate nationwide. We got started in this business because we were real estate investors, have been for the last 10 years. We started this business about 5 years ago now, just because we saw the need for some brokers that would treat customers fairly and and be honest with people. So we were having trouble finding that on our own. Um, and so we decided to become that ourselves. And we've been in business now for 5 years. So we started the business to be a service to the real estate community, and that's what we have been working to do. So this is our contact info, our emails, and that is my cell phone. And then that, if you hit that QR code there, that is my Hi Hello card. So you can scan that and connect with me on Hi Hello. So I'm going to go ahead and start with the before I move on, I want to encourage everybody to put your information in the chat. Tell us where you're from, what markets you are investing in, what kind of work you do, maybe. But just put your contact info. Let people know who you are. You never know who's in here and who might need what you have, or that you could be a service to them or them you. We've had people that have connected on our chats, that have done business together. So it's a good place to meet people and to connect with people. So I want to encourage everybody to do that. Um, if you've had any success stories here recently or anything that like that, put it in the chat. We'd love to hear about them. So current debt market update. We started these calls, around the time that the rates and things started going up like crazy, and things. I guess it's been what, 2.5 years ago. I don't know. I lose track of time, but it's been a little while ago now. And we was just doing a current debt market update because it was changing so drastically every day. It's changing back and forth a little bit still, but nothing like it was. And I think for about a year and a half or 2 years, everybody, after it jumped up so high and it's just kind of stayed there, everybody's just been waiting, and expecting every day that they're going to come back down, and they just never have, you know. And so we've been talking about this same thing for the last 2.5 years of where are the current rates. We've had 75 basis points in rate cut from the Fed. The last quarter of last year. Um, but the final rates that we pay have not come down. So why are the rates we pay, on whether it's our home mortgages or commercial mortgages or any kind of debt, why haven't they come down? The reasoning is, the treasuries, the treasury rates or treasury yields, those are still staying high. We've been up close to 5%, and every so often we get down close to the threes, but it's been staying in the fours here for quite a while now. And the treasuries determine the rates we pay, our final rates. So when you're looking at debt on deals, and you talk to a bank or you talk to us or whoever it is, we say, well, we're going to be, 2 points over the 10-year. That means you take that 4.5. So the final rate you would pay on that deal would be, 2 points over the 10-year treasury, which would make it 6.5. So, different banks will have different spreads, and not everyone will use the treasuries. You'll have some that use the Bank of America Prime. You'll have some that use um, SOFR. A lot of different a lot of different things they use. But when we're looking at long-term debt on mortgages, it's generally the 5, 10, 7-year treasury that people are looking at and basing the rates on. So, we've been in a stagnant market here for a little while, and it's starting to break free a little bit. There's things that starting, business is starting to happen. A lot of people in the business that we're in, um, I guess it was 2 years ago now. They were saying that half of the mortgage brokers in the country are going to be out of business, commercial, residential, you name it. About half of them are going to be looking for other work. And I've seen that. A lot of the private lenders have shut down their shops. There's been a lot of things happen that, where people have just, they can't stay in business because they're not closing enough deals. The guys doing short-term debt, if they lent money out before the rates kicked up, that money's still out there on the street and they can't recycle it. There's just a lot of that kind of stuff that is going on. And, there's not been a lot of trading happening. And new debt coming out. A lot of the trading that's happened has been done with assumable debt, things like that. But I think people are starting to come to grips with the new rate market that we're in. Um, it's a big jump when we go from 3, 4%, 3 and 4% rates, and now we're at 6 and 7% rates. It's a big jump, and it's a lot of it's psychological, but a lot of it is just the deals don't work. That suit the seller and suit the buyer. Right now because they have different expectations. So I think the sellers are going to have to come to grips that their expectations don't matter. If they need to get out of a deal, they're going to have to sell it for what a buyer will buy it for. But you know, that's just going to be a thing that is kind of long and drawn out here, I think, over the next couple years. But yeah, people are starting to come to grips with the new rate market, losing faith in the rates coming down. Um, a lot of people are just thinking that we're going to be at this range for a long time. That we just got to get used to it and start dealing with it. And there's a lot more deals coming to the market because of when we're looking at the commercial mortgages. You'll have a set rate for 5, 7, 10 years, and if that 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 time runs out, you've got to your rate's going to go adjustable, and you got to refinance to protect yourself to keep you from those new rate increases and things. So, but there's a lot of this debt maturing here, 2027. $2.7 trillion of debt maturing by 2027. Half a trillion in 25. But these numbers will be higher because over the last 2 years, there's been a lot of debt that has matured that hasn't refinanced, hasn't sold, and they've just gone on extensions. Banks are kicking things out into the future, hoping rates will come down. That they'll be able to get out of these loans that they've written. Without the owners losing everything, or without them losing everything. Um, but I think these numbers of debt maturing are going to be higher because at some point the banks are going to have to say, enough's enough. We're not kicking things down the curb, no, downfield no more. We gotta just rip the Band-Aid off, and that's going to happen at some point here.
Hey,
Yeah.
I'm trying to find my raised hand and I can't find it. They change these things on me so often.
Oh,
Anyways, Sean Thompson is here and he
Yeah.
has a question in the chat.
Okay.
He said, is this a good time to buy, expecting rates to come down later?
um, yeah, people were saying that was the case a year ago, 2 years ago. Um, but that's the question right now. That's the question of the next couple of years, I think. Um, if anybody knows, let me know. Because that's a good question.
Yeah.
But
Ryan said that's the $1 million question.
yeah, yeah, yep. Um, yeah, I mean, I have an exercise planned here on the next slide. Um, so yeah, so I mean, if rates do drop a couple points over the next couple years, people that have bought now, it's going to be a very good situation for them. Um, and I'll show you why here. It's yeah, that's the hope, is that if you buy now, that rates are going to come down a couple of points, and what you just bought at a 7.5 cap or an 8 cap, that you can now sell at a 6. I mean, that's the hope. So cap rates have gone up because our rates on the mortgages or on the notes have gone up. And when the cap rates go up, values have gone down. So if everybody can take out your phone, or whoever wants to participate, we find our our cap rates. We use our NOI and divide it by the cap rate uh, to come up with the value of a property. So if we have an NOI, if you take out your phones, and we have an NOI of $500,000, and let's say this is 4 years ago, and this $500,000 NOI, we can sell this property. I mean, when we're buying and selling a property, we're buying NOI. We're not buying, yeah, we're buying the bricks and mortar and all that, but what we're buying is the cash flow, right? We're buying the cash flow from the property. So the NOI is the cash flow, net operating income. So we take that $500,000, divide it by point oh, let's just do 5.05. So $500,000 NOI at a 5 cap, that means you have a valuation of $10 million. So if you have an interest rate of 4.5%, you can probably sell that property at a 5 cap. That property's worth 10 million bucks. That same property, let's say now we're going to get 6.75% interest rate. $500,000 NOI divided by, with a 6.75 interest rate, we're going to be at, like, let's say a 7.5 cap. So 500,000 divided by 0.075. Now we're at a $6.6 million valuation. So that interest rate moving what? 2.25 points gives us approximately $3.5 million of less value. So looking the other way, you buy that property with a $500,000 NOI at a 7.5 cap. Let's say 2 years from now, our rates drop a couple points, and we're now buying that same property at a 5.75, so 5.75. Now we're able, that property's now worth 8.6. So that's the hope, is that the rates go down after you buy a property. Cap rates go down as well, and that's going to raise the value of the property. So that's what the rates going up have done to the market. I've talked to a lot of building owners that are in a big trouble right now because they have $8 million in debt on a property, and the most that they could refinance the property for is 4.5 or 5 million in the current rate market. And so to be able to get out of that deal that they've got, I mean, they're going to have to put some money up, and their equity partners, their LPs, are going to lose out on it. So that's the current debt market and where it's at. Right here is Freddie Mac small balance. This is the current rates that you'll see on the small balance end. You can take 25 to 35 basis points, off of uh, off of those when we get over that $7.5 million loan mark. And this is the Fannie Mae, what it looks like right now. And I'm going to get on to the main topic, which is all about financing the smaller deals. So we're talking about financing the smaller deals. Some of the smaller deals are easy to finance. Some of them are more difficult to finance. Um, and I've talked to different lenders, decision makers at the lending houses, to try to understand different reasons why this one is, more difficult to find funding for in comparison to that one and things like that. But the deal right now that's easier than any other deal to get funded is just your straight DSCR loan. So when we're looking, and I say the DSCR loan, I mean, they're all based on DSCR, but that 1 to 4 units, single family rentals to four units, those are the easiest properties to get funded, that have a cash flow. So if you have a 680 or better credit score, um, a small down payment, and a deal that will cash flow, you can start getting into these deals. Um,
Questions in the chat.
okay.
There's one from Edward.
Yeah.
Edward,
What's up, Edward?
Pastor Edward.
Yeah. Yeah. Go ahead.
He said, how do you view the current rental demand given its sustained strength? With high demands, wouldn't the market support the financing, making this a favorable time to invest?
Oh yeah. I mean, depending. I mean, just about everywhere seems everywhere I've looked at, seems to have high demand for rentals. Um, Edward, we go to church with Edward and know him pretty well. He's investing here in Cincinnati. We invest on the Kentucky side of Cincinnati. Um, yeah, I mean, as soon as you advertise something for rent here, you've got 50 tenants trying to get in it. It's a good market. Some of the more rural markets are not that way. Those are harder to get funded, more rural areas. Um, but any of the cities that have a lot of job opportunities and things like that, it's if you buy cash flowing property, um, you know, you can't go wrong. If it cash flows today, you have debt locked in on it for the next 5 years. You're gonna win on that property. So over 10 year over the time periods of 10 years, property always goes up in value. You might have occasions where you'll have a couple years where it goes down here and there, but over a 10-year span, real estate over the last 100 years has always gone up. So, um, talking with my grandmother not too long ago, and her and my grandfather bought a brand new house in Monterey, California in the late 40s, I believe. Early 50s, late 40s. My grandfather was in the military out there, and they bought a brand new house, 3 bed, 1 bath in Monterey, California for $8,000. You know, that same house today is a couple million bucks. You know, those first 5 years they owned it, they might have not made money on it if they would have sold it. But if my grandmother, she's still alive today, if she still had it, I mean, it would be more than what she's got in any of her other investments. So
I know
real
you need,
estate just
I know
always goes up.
I know
But
you need to move on, but one more question.
yeah,
What counts as a smaller deal?
um, 3 million or less in loan amount. That's what I'm talking about today.
Okay.
So so now for these for the DSCR loans, the only expenses that we will account for on a DSCR loan on a single family to a 4 unit property, taxes and insurance, any HOAs, and your mortgage payment. And in some markets, we can even go to a 1-to-1 on the DSCR. We don't need a 1-2-5 or a 1-2, 1-to-1 in some cases. So if you're in a really nice area, like a higher end area, some areas in Fort Lauderdale, Miami, maybe up in New York, where you have higher prices and things. That I have lenders that will go 1-to-1 on the DSCR, and that's the only things they will account for as far as expenses on the DSCR end. Rates and terms on these on a 30-year can be anywhere from 6 to 12%, and most of that depends on the location and the borrower strength. On a purchase, we can go up to 80% of the purchase on these. And you can refi up to 75% loan to value. Um, on the smaller deals, funding the rehabs, fix and flips, you can get into a fix and flip for as little as 7% down on the purchase, and then all the construction costs can be funded. And it'll be rolled into the loan. You'll draw funds on completed work. Rates 9 to 14%, interest only, 2 to 6 points to close. And these are wide ranges just because if someone has credit issues, it's a deal that is not real attractive or more risky to the lender. They're going to charge more. They're going to charge more points, and they're not going to do the 7% down as well. I mean, sometimes you might have to bring 40% of the purchase if it's a deal that isn't real attractive to the lender. And most lenders in this realm are going to require you to pay for an appraisal up front to determine the after rehab value on these deals. So now the smaller deals when we're talking about going commercial. And when I say commercial, that's anything over 5 units or more on the multifamily side, or anything that maybe isn't an apartment. Maybe it's a strip center or car wash, storage, self storage, just all those types of things. Smaller mobile home parks, and I'm talking about 3 million and lower in loan amount. Well, we're talking of the agency loans, so Fannie and Freddie. Um, they will go down to like 1.5 million on the loan amount. on certain occasions. If it's a nice property in a nice location, they'll make exceptions and go down to those amounts. They don't like to go under 2 million, but they will go to 1.5 million on cleaner deals. Um, Now, when I've talked to different bankers and different lenders and things on these deals, when we're looking at, older properties, we have a lot of older properties here. I don't know who else is in the Midwest, but here in our area, Cincinnati, Northern Kentucky, even Indianapolis, Columbus, um, this whole area that we're in, there's a lot of older properties that are, 5 to 15 units, 16 units, and some of them, some of these properties are 150 years old. And these older properties that, um, somebody that is buying them that, isn't as sophisticated in a lot of times, that are buying these deals. They're, maybe they've got a good job and they got some extra cash flow or a business and they buy a deal like this, and that deal just sucks them dry of energy, because the only way they're going to make money on it is to manage it themselves and to do a lot of the work themselves, because these old buildings need a lot of work done. When they do get work done and they hire it out, it's going to be more money because it's harder work to get to work on these older buildings. Just it gets to be real expensive, and some of these properties like this have some of the highest default rates when we're looking at, loans that don't get paid. So when you're looking at getting these funded, a lot of times they're a lot more expensive to get funded, just because of the higher risk to the lenders. So I mean, I've seen, and then if we're looking at these smaller deals and we're looking at maybe a small office building or a commercial, where you have, maybe a little strip center, things like that, it's going to be even worse than if it's multifamily, because these are unsophisticated investors a lot of times that don't, maybe it's their first strip center and they've got 4 commercial tenants that don't know how to deal with. They don't know how to write a lease. They don't, a lot of things that they don't know, and sometimes you just got to learn by hard knocks. And these deals are just more expensive. I've seen them as much as 10 and 12%, on long-term debt, that people have been quoted. So when people are trying to sell them and you see them selling for, oh, we'll buy this for a 9 cap or whatever, and your interest rates are going to be a 10 or 11, it's not a good deal anymore. So um, just be aware when you're looking at these types of deals. And these rates and terms are all over the place. And the types of lenders for these deals can be, private lenders, banks, and a lot of times a small bank in that local area is your best option on some of these deals. And I said agency financing, so Freddie and Fannie are a good choice on the smaller ones if you can get them through on Freddie and Fannie. And then SBA can be an option if it's not an investment property. If it's got a business attached to it, like, you know, let's say a mobile home park, or not a mobile home park, but an RV park that has a business where they're working with, more like a hotel run type deal. The long term tenants at an RV park will kill the SBA option, but if it's a short term RV park, small hotels, self storage, those types of things can qualify for SBA. Um, but I will say SBA is very expensive, in this current market. Um, some of the best rates you'll get SBA right now are in the 7 and 8, 9% range. But SBA will allow you to get more leverage in some cases. If you do 10% financing from the owner, you put 5% down yourself. SBA will sometimes lend 85% of a deal. So so that's the financing, small deals that I have for you. A lot of these commercial deals are on a deal by deal basis. If you have deals that you're looking at, I would love to help you with them. I'll put my contact info back up there in just a minute. But today's verse, do not defraud your neighbor, or do not defraud or rob your neighbor. Do not hold back wages of a hired worker overnight. So pay people quick and pay them often and take care of people. And that's very important in this business, especially because you don't want to get that reputation of somebody that doesn't pay their people or that pays slow, pays late. You'll have a hard time finding people that want to do work for you. So, and I think that goes for investors too. If you have investors and things on deals.